Hi there, welcome to Kneppyinvest. It is one of my favourite times of year on the Australian calendar, particularly the investing calendar, because this time of year, April, July, October, and January, is the time we see smaller Australian companies, particularly those who are not profitable, release their quarterly cash flow reports, Appendix 4Cs and 5Bs. At the same time, on the American markets, the big companies, or all the companies over there, are releasing their quarterly financial reports. They do have a quarterly reporting system. Our system, in regards to all the financial statements, companies only have to release that twice a year. So slightly different reporting systems between Australia and United States. And I thought today, what I'll do is start to have a look at American quarterly reports. And I'm going to start with Netflix. And there's a simple reason I started with Netflix. I got an alert that they did release their quarterly report. And as soon as I started reading the quarterly report, it was quite obvious the share price was going to go down. In fact, pre-opening suggestions were the share price was going to drop 20% on open. It did. It dropped 20% on open and then kept on falling during the first hour of trading and finished the day 35% down. So in this video today, I'm going to go through, not too deeply, Netflix's quarterly report to delve into the reasons why the share price dropped 35%. And the question becomes, is this an opportunity to buy this quality company at much cheaper valuations? For those who don't know what Netflix does, I think it is time to stop living in a cave or under a rock. So Netflix has been around for quite a while, and I actually did work once at Blockbuster. So I always love that story of Netflix. I'm not sure exactly how it goes, but Blockbuster could have bought Netflix for a song. They said no, there's no future in it, or something like that. And I love to use that example of how incumbents sometimes can't see the future. This was a future. Netflix was a future. And they've grabbed the bull by the horns, and their valuation right now is over $100 billion, while Blockbuster no longer exists. Might be one store, maybe, but it no longer exists. Anyway, let's have a look at some of the financial data for Netflix in the past year. So this is the financial year 2021 data. So this is up until the end of December last year. Revenue, 29.7 billion, and this is a growth company. Everything has been growing. And one of the reasons why share price has dropped a lot is because there was one thing that did not grow from last quarter. I'll talk about that as we discuss the most recent quarter report. Nice gross margins. Operating cash flow is really lumpy. That's one thing I really noticed when I looked at financial data for this company. For instance, in financial year 20, operating cash flow positive by 2.4 billion. In this most recent financial year, operating cash flow positive by only 393. In previous years, financial year 2019, 2018, 2017, there have been some years where this company is highly operational cash flow negative, spending a lot of money, more than likely spending money to produce films and TV series. Profitable by $5.1 billion in the financial year 21, up from $2.8 billion in the previous year. I'm not sure how reliable that jump in profit is. Wouldn't be surprised to see that profit line come a fair way back in financial year 22. Now to the market. The day before they released their quarterly report, the share price was $348.61, giving the company a markup of $154 billion. Now, the share price of this company towards November last year was about $700, which means the markup of this company would have been approaching or maybe even above $300 billion. But at the end of closing on April the 20th, Netflix share price was $226.19, giving it a markup of just on $100 billion. So a significant fall in valuation for this company, not only because of this report, but also over the past 5 months. When you have a look at some of the valuation metrics, EV to operating cash flow and PE ratio, I'm not sure how reliable these are because EV to operating cash flow is 254. And because operating cash flow is quite lumpy, that valuation metric would go up and down quite a bit. So I really wouldn't take that a number too hard and say this is completely overvalued. But if you look at PE ratio, 19.6. And if this company continues to grow, you might say that is quite low, and this company could be looking like it could be good value. But the one thing is that's based off the profit of $5.1 billion. I'm not sure how sustainable that is in the next year. So again, wouldn't be surprised to see that pullback, which would make the forward-looking PE ratio actually be a little bit more. If, say, profit is $2.5 billion next year, that would give this company a PE ratio of just under 40. Now let's have a look at their quarter one results. And I do like this table they do provide. So this is straight from either the presentation, I think it was called Letters to Shareholders they did release. And this is quarterly numbers over the past 5 quarters. So looking at quarter one, or starting at quarter one 2021 and finishing with the most recent quarter, which is the first quarter of financial year 22. Revenue has been growing at a nice consistent rate from 7.1 billion to 7.9 billion. They've also forecast revenue to continue growing in the next quarter. So they also have included operating income, operating margin, net income, diluted earnings per share, net cash from operating activities. That's something I always like to look at. It's the main thing I do look at, particularly in Appendix 4Cs and 5Bs. Free cash flow, shares, and most important here is global streaming paid membership and global streaming paid net additions. That's the big one here, because global streaming paid memberships actually fell from the previous quarter, and that's why the market had an absolute hissy fit. And the company expects paid memberships to actually fall even further during the next quarter by about 2 million paid memberships. So that's the reason, the whole reason why the share price of this company fell 35%. Maybe not the whole reason, but it is a major reason. So why is the growth slowing down? Why is it negative now in terms of paid memberships? The company did address this in the letters to the shareholder. There were 4 main reasons. First one is the underlying addressable market, broadband. And they actually mentioned they don't have a direct control on that, which is absolutely understandable. So I'm not really sure why that is the reason why there is slowing growth. But they did mention that that should grow over the next few decades. And that's without doubt, broadband use around the world will grow, will become quicker. The next 3 are probably better reasons why growth is slowing for Netflix and actually has gone backwards in the past quarter. Shared memberships, they mentioned like 100 million households have a shared membership, which means something like 200 million households are paying, and then 100 million households are not paying, and they're just using someone else's account, something like that. They want to monetize that to take it, because that's, you know, people using their services for free in effect. Competition, increasing competition. There's been a plethora of these streaming services over the past few years. Netflix is by far the biggest one, but we are continually seeing more and more of these streaming services come online, and that is having effect on the growth of Netflix. And macroeconomic factors, we're talking about Ukraine and Russia, inflation, all those sort of things are having an effect on the growth of Netflix and their membership base. It was really good to see that the management of Netflix acknowledged the headwinds this company is facing. But then the next question, of course, is what are they going to do about it? No point sitting on their backsides doing nothing. This is the reason they're paid their big bucks. They want to invigorate or reinvigorate growth over the next 5 to 10 years. Now, this company has faced these sort of problems in the past. I'll talk about 2011 or later in this video. So they had 4 ways they're going to reinvigorate growth. And I think the first way is the most important thing, and that is program quality. Now, it seems like Netflix releases a plethora of TV series and movies. Not all of them are successes, but at least some of them do stick and become highly popular. The other thing they're doing is expanding around the world. So we've all watched like Squid Games and TV series. That was Netflix, wasn't it? Squid Games, which was Korean, and I'm sure that's going to become popular in the future. International series will become popular all around the world. So that is one area where they will be growing. So program quality, I think, comes with the fact that they just produce so much content, and some of that will stick, or some of those TV series and movies will stick. It would be intriguing if they created this universe, this brand, just like Disney have done with Star Wars and the Marvel universe. So I don't think you can plan that. I think it just happens naturally. And that would be beneficial because then you have this whole merchandising income stream that just opens up, and merchandising margins must be quite high, I imagine. Another way they're going to reinvigorate growth is improve the personalized recommendations. Now, I am a Netflix subscriber, and I don't care about personalized recommendations, but apparently a lot of their subscribers do like it. And they've introduced this thing called double thumbs up. So instead of just liking a TV series or movie, you can give it a double thumbs up. And that's like you saying you love this TV series or this movie. They want to monetize sharing. So this, I think, is very important. Why are all these 100 million households in the United States getting a free lunch? And I've already mentioned international products. Put more money into those areas because they do think that's where the major growth is going to be for this company over the next decade. Always like to see goals or expectations a company might have for the next 5 to 10 years. And they did provide this in the letter to shareholder. So their goal is to sustain double-digit revenue growth, increase operating income even faster as we expand margins, and generate growing positive free cash flow during this period of slow revenue growth, assuming no material swings in foreign exchange. We aim to protect our profitability and manage to a minimum operating margin roughly in line with current levels. This is 19 to 20%. Once we've re-accelerated revenue growth, we're committed to steadily growing our operating margins. So they do have goals, expectations. That's very handy. Now, the question is, can they meet these goals and expectations? That's the big thing. The market has to ask themselves, can this management succeed in these goals? And if they do succeed in these goals, I think this company is starting to look more and more attractive as the share price falls further and further down. Now let's have a look at the updated chart, and this is to the end of trading on April the 20th in the United States. And this is the daily chart going all the way back to February 2020. So this also includes the COVID-19 financial panic, bit of a blip on Netflix share price. And the share price right now is significantly lower than the COVID or the lows in the COVID-19 financial panic. And the share price high for this company was $700, which was reached in November last year. So share price has gone from $700 to just above $220. So significant decrease in share price. But before the release of this quarter report, we also had the release of the last quarter in January, and the market didn't like that at all. I think the share price fell 20 or 30% on the back of that. Before the release of that negative report, the market had shifted its sentiment in this company. You can see the share price fall from $700 to about $500 just before the release of their last quarter report in January, and the share price has just kept on falling since then. So definitely the market was expecting maybe some trouble moving forward for Netflix. That's why the share price has started to move into a downtrend, and probably the overall negative sentiment in the tech sector had an effect on the share price as well. So sometimes it is prudent to see what the market is thinking about a company. And just before the release of their January or last quarter results, the market was a little bit negative about the future of Netflix. And that's why share price had moved into a downtrend. And the market seemingly was right, because the share price has kept on falling. And if we take a look at the weekly chart, this goes all the way back to 2012. If you were a shareholder in 2012 and you maintained a holding of this company, you've done very well, because the share price back then was less than $20. And even with this massive fall in the share price over the past 4 months, you're still highly in the green. In fact, this would still be a 10-bagger for you. But you can just see how the share price has fallen off the cliff over the past 5 months. So this is all about greed and fear. Fear is much more powerful than greed. That's why share prices in the markets tend to fall much more quicker than the rises. And the question we have to ask ourselves is how much further the share price has to fall from here. It does look like a falling knife situation. In those sort of situations, it's really, I think, advantageous to remain patient, just to wait for this negative sentiment to wash away, because it could last for a while. And if they release another negative quarter report for this current quarter, that could exacerbate the movement down in the share price for this company. So share price could fall a lot from here. We just don't know, but it looks really negative just looking at this weekly chart. The share price has just fallen off the cliff, and you don't want to see the share price of a company fall off a cliff. Now, in saying all that, what's happening now sort of reminds me of what happened in 2011 with Netflix, because late in 2011, the market got a little bit nervous about this company as well. In fact, this is the daily chart for the company starting in 2010 and ending in 2012, or started 2012, so 2-year period here. Nice uptrend from 2010 to about July, August of 2012. Share price rose from $8 to $42. And then just like we're seeing now, share price then fell off a cliff, some negative announcements. In fact, subscriber base fell. I think it was the October report. They did see subscriber base fall. So a lot of people thought this was the end of Netflix. The share price fell from $44 to about $9 or $8. This was not the low in the share price. Over the next year, the share price went sideways. And we'll have a look at the chart of Netflix just to see how long it took for the share price and the sentiment to turn around. So let's have a look at that right now. Actually, before I have a look, this is just a news article I did find from 2011, eerily similar to some of the articles I did see for this latest quarterly report. Netflix subscribers down, Wall Street disappointed. Netflix shares get pummeled in after hours trading after the web's leading video rental service reports fewer subscribers than expected. October 24, 2011. So let's have a look at the chart of Netflix from about 2011 to 2013, just to see how long it took for the share price to turn around and sentiment to go back to being positive. Before the release of that report, which was on October 24, 2011, share price had already been falling at that point in time. In fact, on the release of that report, that was nearly the low in the share price. But it took over a year for the share price to move sideways. And we saw a period of time in 2012, October through to about October, November, where we did see share price reach a bottom about $8. And then shortly after that, we started to see the share price turn around. You can see the two moving averages here cross over in that period, and then share price kept on moving up. So that was sort of the shift in sentiment, the shift in the uptrend of the share price. And then after that, in January of 2013, the company released some positive news. And that's why you saw the share price increase in one day from about $14 to $21. So a 50% increase in share price on the back of good financial news. That's exactly what you want to do with Netflix right now. Just wait, be patient. Now, this is just my opinion, but just be patient. Wait for this negative sentiment to wash away. Wait for the trend in the share price to turn up. Wait for the sentiment to shift to positive, or even better, wait for confirmation that this run of negative news, of financial news, has come to an end, just like we saw in 2013 with Netflix. And this was the catalyst for a massive re-rating in the share price. Share price at this point in time, even though it increased 50%, was only $21. And just remember, share price high for Netflix was $700, which was reached about 8 years after this release of this positive report back in 2013, January. That's all I have for this Netflix quarter report video. Share price down 35%. If you have any questions about this company or any other company, maybe on the NASDAQ or New York Stock Exchange, I'll gladly answer your questions, particularly if they're going to release a quarterly report soon. I'll have a look at their quarterly report. A lot of companies over there, so I probably won't look at all of them. I'm just going to look at lots of the big companies' reports. I think Tesla might have released their quarterly report overnight in the United States. So I'll have a look at that. And I think pre-market or after hours trading, Tesla share price was up 4% last time I looked. Now, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.